What's up guys, Nick here, back with another video. Most people discovered Zoom in 2020 while stuck at home looking for a solution to keep up with some normalcy in their lives. And Zoom, the company, as well as the stock, blew up this year. The stock went from around $60 in late 2019 to $588 in October of 2020 before falling back down to $337. So I thought during this extended sell-off that now would be a smart time to look at the company and see how the business is actually doing. How well are they really performing financially? What is the stock actually worth, and should we buy now? Zoom was founded in 2011 by Eric Yuan. Yuan had immigrated to the United States 14 years earlier in 1997. After arriving in the US, he was able to land an engineering job with WebEx. After Cisco purchased WebEx for $2.3 billion, Yuan became Cisco's corporate vice president of engineering. In an interview with Thrive Global, Yuan said during his 14 years with WebEx, he realized there were some pretty serious flaws with the program. He said due to the older architecture in WebEx's design, it was hard to use and wasn't very reliable. He told Cisco's leadership about this issue, but they didn't listen. So in 2011, Yuan founded Zoom along with a bunch of former WebEx engineers. Zoom remained a pretty light operation at first with Yuan. As the CEO, he was still personally involved in some of the customer support directly, and Zoom had no dedicated marketing team. But after 2 years, they gained over 40 million individual participants, even with the competition from Skype, Google, and Cisco. Zoom says its mission is to make video communications frictionless. And when a global pandemic hit, forcing people to try their best to continue interaction, now virtually, Zoom's simple but effective design put it in a unique position to take over the market. They allowed up to 40-minute group video calls of less than 100 participants for free. Conferences were easy to set up, and they worked on all devices including desktops and both Apple and Android mobile operating systems. Zoom could even continue working with a 40% data loss, so even those with weak internet connections wouldn't experience disruption. And because of the ease of use and all of the word-of-mouth marketing that came from it, they went from 10 million daily meeting participants in December of 2019 to 300 million by April of 2020. Looking at a Google search trend chart, we can see just how fast it happened. And it happened so fast that Zoom actually didn't have the opportunity to test their product against this type of scale and attention. Pretty quickly there were stories about people Zoom bombing, which is when Zoom bombers found a meeting ID posted somewhere in public online or used software that tried random room IDs until they found a live meeting. Then they would join the meeting through the discovered ID and would try to disrupt it somehow. Then more concerns came up about Zoom routing its meetings through Chinese servers. Routing the data through China would mean that the encrypted data would become subject to local Chinese laws, allowing the Chinese government to possibly access the encryption keys, giving them access to the data. Zoom CEO Eric Yuan apologized and said that the reason Zoom routed the data through China was to add server capacity to keep up with the rapid increase in demand they experienced. He said that they didn't fully implement the geofencing feature that would have prevented the North American regions from connecting to systems in China. Zoom later announced that paid users would have the ability to choose what regions their data would go through, and by default, Zoom would only route your data through the region that you're located in. For free users, Zoom would actually lock their data centers to the default region their account was associated with. Now, Zoom gained the early edge in video conferencing in March and April, eventually hitting 300 million meeting participants. But Microsoft Teams has quietly seen impressive growth and hit 115 daily active users, which is actually up 53% since April of 2020. And it's hard to tell exactly how Zoom and Teams compare in size because they use different metrics to measure growth. Zoom is measuring anybody who attends a meeting, and Microsoft Teams measures by Teams users. Teams revenue is actually mixed with the rest of the revenue from Office 365, so we also can't compare revenue directly either. I think an important point when looking at Teams versus Zoom is Microsoft actually offers Teams for free for anybody that already has the Office 365 subscription for business. I see this as a challenge that Zoom will have to figure out how to deal with if they want to gain those paying business customers. It just might make more sense for business owners who already have access to Teams to just use that service instead of paying for a Zoom membership. But for those who don't have the Office 365 platform already, Zoom may make a lot of sense depending on how the business feels about Zoom's security concerns. From my own experience using Zoom, it's incredibly easy to use because nobody has to download and install the software. Zoom very clearly achieved its goal to make video communications frictionless. I do have some concerns about Zoom being the platform that friends and family may use and never have any intention to upgrade to the paid version. Trying to convert those customers may be a big challenge for Zoom. Now, Zoom Meetings is their biggest and most important product, but they also have the Zoom Phone, which is a cloud-based phone system, Zoom Chat, Zoom Rooms, which is a full video conference system, and Zoom for Developers, which allows developers to integrate Zoom's video, phone, and chat into other applications. So let's take a look at Zoom's financial performance and see how they're actually doing. So starting with revenue, operating income, and net income, we can see the explosive growth between 2020 and 2021 that we would expect. Now keep in mind that these years ended in January of each year, so 2020 on this chart is all pre-pandemic activity. They grew from $623 million in revenue to just under $2 billion the following year. When we look at this by quarter, we can see just how the growth has changed over the year, with each quarter continuing to gain ground. But the last two quarters, ending in October 2020 and January of 2021, growth did slow down. And when we add in the revenue growth percentage, we can see how growth did slow to 17% in October of 2020 and 13.5% in January of 2021. Comparing the revenue to expenses, we can see that sales and marketing are a pretty large portion of their expenses. We can also see how the cost of revenue over the past year increased at a much larger proportion than the revenue increase. I would assume this has a lot to do with the unexpected and sudden increase in demand they experienced. Moving over to the balance sheet, they reported $5.3 billion in assets compared to $1.4 billion in liabilities. This gives us $3.8 billion in equity. They actually reported no debt at all on their balance sheet, and on top of that, they actually have $2.2 billion in cash and another $2 billion in marketable securities. So this is a fantastic balance sheet that seems to say that Zoom currently has a lot to work with in figuring out how to add to its services in the future. Okay, so let's take a look at the valuation and see how the stock price matches up with its value. But before I do that, if you found this video helpful so far, please take just 1 second and help me out by hitting the like button. So looking at the forecasted earnings, analysts currently think that Zoom will continue with pretty rapid growth going forward, hitting just under $6 billion in revenue by 2024. The current fiscal year, which is actually 2022, is projected to earn $3.8 billion and earn $3.72 per share. So I think that what's tough about this valuation is trying to determine the growth for them going forward. It's hard to know exactly how big the video conferencing market will be and how much growth that they're going to lose to competition. The tech world can change very quickly, especially if there isn't a strong moat for the business. And I have some doubts that Zoom's current moat, being the verb and having a product that's simpler to use than all the others, will keep them protected against the competition when it comes to attracting business customers. And this is especially if there's a lot of money to be made here. So I'm going to try to look at the stock in two ways. The first way is if Zoom is able to continue to grow at 20% going forward. And for this to happen, I would think that Zoom would have to keep Microsoft Teams and all the other video conferencing platforms from eating into their growth. As things improve with the pandemic, demand for video conferencing of course will decline, but it's hard to say exactly how much. The second way is if some of the other video conferencing apps take some of the market share away and video conferencing has some fall off. In this case, I think we could expect about 10% growth going forward. So at the top end, 20% growth comes out to a fair PE of 55. At the bottom end, 10% growth comes out to a fair PE of 22. So for 2021, Zoom earned $2.25 per share. This gives us a bottom end valuation of $50 and a top end valuation of $122 per share. 2022 is forecasted to earn $3.72 per share. So this brings the bottom end valuation up to $81 and the top end number up to $201. Analysts see for 2023 Zoom earning $4.09 per share, which means a bottom end valuation of $90 and a top end number of $221 per share. So if we look at this on a chart, this means that the current share price won't be justified until late 2025 under the most optimistic outlook. What's kind of crazy right now is the consensus analyst earnings for 2024, which is a long way away and definitely going to change before 2024 gets here, is $5.01 per share. This means that at the current share price of $337, it's trading at a forward PE that's still 3 years away of 67. If we take a look at the 6-month stock chart, it currently looks like Zoom had a pretty big head and shoulders pattern between September and November, which resulted in breaking under the 50-day moving average. Most recently though, Zoom had a pretty big rally in early March and then a huge gap down, breaking through the 50 and 200-day moving averages. So looking at this chart, I don't think that we found the bottom yet. If it was totally clear how the future was going to go for Zoom, meaning we knew that they would dominate video conferencing going forward and growth would sustain, I would think differently. But even under the best case scenario that I see, I don't expect the current share price to be supported by its earnings until 2025. Now it's important to point out that you can have a well-run company that continues to do well going forward, and a stock price that is just way too high and not supported by the financials. It seems like what happened early on in 2020 is Zoom's stock price got way ahead of itself, and as they've only met earnings expectations and not blown them out of the water, people have started to come to their senses about Zoom's growth going forward. So I don't own any Zoom stock, and I don't plan to buy any in the near future. If we spend time looking at different companies' prices compared to the valuations, I just think that there are much better values out there with plenty of growth and clearer futures. I actually really like Zoom as a company, and I would like to see them do well going forward. I've used the product myself many times, and I absolutely love the design and the philosophy behind the product. Now, if you like this kind of content and you want to see more, make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.